Jason, we've just been watching what's been happening with yields. The 10-year now at the highest levels since 2007. Got the 2-year pushing back up, too. How much of this, we watch the Dow futures, every tick higher for those Treasury yields. How much of this is a good reason to be concerned about things, and how concerned are you?
I think it's a good reason to be concerned. And, it seems like a quaint notion, but, before the era of QE, most investors would expect some sort of premium over inflation to lend money to anyone, including Uncle Sam. So, right now inflation's 8%, and you're getting 4% back, 4.5% back from the government. It doesn't sound like a particularly great deal to me. And so one of the things that worries me, I think, and when I talk to institutional investors, is that while many people have priced in higher Fed funds rates, very few people think that the 10-year Treasury could move a lot higher. And I'm not quite sure why that is. Maybe it's just habit, after 14 years of the Fed training us to think that way. But to me, that clearly is the risk. And of course, I know I don't know, but it wouldn't surprise me if 10-year Treasury yields moved higher.
And if they do, your concerns play out how?
Well, listen, I think, Becky, there's a lot of companies in the major indices that either have very little in the way of earnings or no earnings at all. And so those companies wind up almost becoming like zero coupon bonds, right? The entire value winds up being in the terminal value of the company. And so if you're trying to discount that terminal value of the company by higher interest rates, the value moves significantly lower. And again, these are kind of old-time conceptions of how you value stocks. But I think with the quantitative easing basically out of the way globally, investors and fiscal policymakers just do not have the shield that was provided to them by very easy monetary policy. And so we're coming to a conclusion, or we're coming to a point at which we're actually seeing what the real cost of capital is for the first time in about 14 years. And so that, to me, it argues for quality. It argues for companies that have real cash flows and earnings, that can pay dividends, that can return money back to shareholders. The other companies are going to have a very tough time, it seems to me, until inflation is really brought back under control.